Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. And now, here's Philip.
We are back with another episode of Wealth Building Made Simple. We got Allison Rife Martin, the CPA extraordinaire. What's going on, Allison?
Are you surprised like me that we have 5 months left in the year?
I'm just surprised the universe is still like doing what it's doing with all the chaos in the world.
Well, actually, I will say one of the ways to help yourself deal with chaos is to focus on how you can help others. And one of the great ways to do it is through giving and, through your time, talent, treasures. And so I thought today maybe we could talk about a topic I know we've talked about before, but how can you be philanthropically minded and benefit yourself all at the same time?
Let's do it. Let's talk about it.
From a tax perspective. So
let's talk about how we do that.
Perfect. So we all know that, right now the Tax Cut and Job Act bill includes an itemized deductions, and it's always been included for that matter. You can deduct charitable contributions that you give to your charity of choice, such as the I Love Everybody organization, that if you give enough to get you over the standard deduction, along with your property tax and mortgage interest, you are able to get a tax benefit from it because you can increase your itemized deductions.
What's that, like 25,000?
This year, I think it's $25,000 or so for a married filing jointly couple. So married filing joint couple. So there's a lot of opportunity. If it really works if you have a mortgage interest and a property tax.
And let me break that down, because I've had people, insinuate that we start talking nerd talk. So if we break it down, right, that the 25,000 means like we can either take the $25,000. It's not a credit, right? It's a deduction.
It's called the standard deduction. So let's say your gross income, your taxable income for 2024 is $100,000. The IRS lets you deduct $25,000 if you do standard deduction.
So you lower your income from 100 to 75,000.
That's correct. However, if you have the sum of mortgage interest, property tax, and charitable contributions, possibly medical expenses that are greater than $25,000, you can deduct more from your gross income.
Got it. But you can use either or, right? So let's say I did 10,000 in giving, right? In mortgage, let's say everything in that category, in the non-deduction category, was only 10,000. Then I would just pick the 25,000, right?
So if you, if all you did was charitable contributions of 10 grand, then yes, you would take the standard deduction. You take the larger of the two. But if you had 10 grand in property tax, 10 grand in mortgage interest, and 10 grand in charitable contributions, you now have a total itemized deductions of $30,000. You would take that, you would reduce your taxable income by that amount.
Got it. Yeah, 70 is better than 75,000.
Exactly, right. So knowing that there are so many out there who have the financial wherewithal and the desire to make this world a better place through donating to the charity of choice, if you have mortgage interest and property tax, and again, possibly medical expenses that are greater than the standard deduction, I would give as much as I could financially give, or donate my clothes or household goods to my charities of choice, and I can increase my itemized deductions. Another way to do it and not have to actually come up with any outlay of cash is to contribute to a donor advised fund. And we've talked about those before, and it still affords the same opportunity for a charitable contribution deduction. But here, in this case here, you could contribute stock or other forms of appreciated property into the donor advised fund. And those are uh, run by stock houses or brokerage houses like Charles Schwab or Fidelity or whomever. So you would donate stock again or appreciated property into there. You would get an itemized charitable contribution deduction equal to the fair market value of the stock or appreciated property that you contributed. So there's a two-win for you. You get the itemized deduction and you get to avoid the capital gain on the stock because again, you donated it at fair market value.
Now, here's a question. I know people are thinking, from that donor advised fund, can we
Mhm.
donate to political campaigns? Do those count as no?
No, it has to be a 501(c)(3) organization, like
So
a
like a
religious
super PAC
organization.
or a super PAC? No super PACs either.
Nope, political contributions don't count.
Got it.
And um, so you could give to, again, like the I Love Everybody organization, so long as it's a 501(c)(3), or you could give to a religious organization like your church or your synagogue or your mosque. Um, you can give to, believe it or not, like a PTA, so long as it's a 501(c)(3). There's a myriad of options, but the donor advice fund will manage it as well.
Got it.
So,
So it has to be
anyways,
a nonprofit 501(c)(3) politics.
correct.
I bring the politics question up because everybody's thinking that they're going, oh, can I give to my favorite candidate this year? So
Exactly
no, it
right.
doesn't.
It's one of those, yeah, no, I can't. While you're giving conceivably for the greater good because you believe that candidate will make the world a better place, that's not what the IRS would consider philanthropic.
Got it.
You need to give it to an institution that is actually doing things for the greater good of society, whatever that greater good is.
Right. Yeah. A specific purpose or policy, or I'm calling it policy, but a specific
I know.
purpose. Yeah.
Right. Right. So like, again, like if you think of obviously a religious organization, that's their greater good is to help you, become a better person. So anyway, that is, the donor advised fund or just flat out giving. And if you just want to give, you can also, as a reminder, you don't have to give cash. You can give a lot of times at the end of the year, Salvation Army gets a deluge of clothing and, stuff that people just don't need anymore. And so, and there again, you're giving it to the Salvation Army or Goodwill. Typically, those are, places where you would donate and you get the benefit of being able to get the charitable contribution deduction out there.
Okay.
So the last one and this would apply to high net worth individuals, and it's a good tax planning strategy, particularly for those who have estate tax considerations. It's called a Charitable Remainder Trust. And so think of that as a larger sort of like a donor advised fund, but it's an irrevocable fund that where you would give again things like appreciated stock or whatever just to get it out of your estate and it's placed into this irrevocable trust. You don't own the assets anymore. However, during the course of your life or however you set the trust up, you can earn income off of the assets that are placed in that trust. So if you have a portfolio of stock that is generates a significant amount of dividends, you can get it out of your estate, put it in this trust, and then for again the time period that is designated in the trust documents, you would get the income earned off of that, either an annuity amount fixed as a flat investment amount, or it varies according to the investment income from the assets that you placed in there.
And I'll add one more thing for my tech-focused investors that own assets that don't have a dividend. They might be wondering, can I do mine too? From my understanding, you can also let's say you put some. I don't know why you would do it, but you put Bitcoin in there, right? You can also just sell 5% of it or whatever a year because it's
Mm-hmm.
not taxable when you sell it to generate income and pull it out inside the trust. once you give it to the trust. Because
Right.
the trust is
Because remember,
yeah,
yeah, it's not your asset anymore. But again, it still provides a source of income to you that during the time period that you need it. So Bitcoin, if it's not really going to be an income generating asset, I'm not sure I would think to do it to include, you still might want to include it,
yeah.
it- but obviously remember it's a charity that would ultimately be the beneficiary of the assets in the trust.
Well, the only reason why I clarified that is I was saying like you can. So the example, as I understand it, let's say you put $1 million of whatever in there, income producing or not. The attractive part about it is you can actually manage the trust while you're alive. You just got to follow the rules of
Right.
that, but you can actually manage it and have it own what you want to own, and then you can. Let's say you say I want to take. You set it up to where you want to take 5% a year out every single year, right? Once it's in the actual, you know, trust, then you can buy and sell whatever you want with no taxes and trigger the income you need, as long as you follow those rules. So that's why I was saying, because I had a client that had some highly appreciated. He was an executive at a tech company, so I went to go talk to a thing, and they were like, "Oh yeah, you can do that, put it over here, generate that." So I kind of nerded out on all those rules. Again, work with your CPA and the attorney, but my
For
understanding
sure.
after the conversation was you can generate income the same way you generate income in your retirement portfolio by just selling assets to generate the income. And because it was
Right.
in the tax efficient vehicle, you didn't trigger a tax when you sold it to generate the income.
Right, within the trust, yeah.
Yeah.
And you're 100% right. It's important to be sure that you have an estate attorney very well versed in this, setting up the documents just to be sure they've got all angles covered, from making sure it's really considered you don't own it anymore, making sure that the tax planning considerations are taken into consideration. So again, yeah, you'd want to make sure that you work with a strong estate attorney and a strong CPA just to be sure that you're doing everything correctly. But it's a wonderful estate planning tool.
Yeah. Yeah. No, definitely.
So,
Any any other thoughts or topics or I mean those are good.
I
I mean
just,
those two are
I
like
think these are
really
great. And it's, we have 5 months left in the year. Most of the time, we don't necessarily really start thinking about giving until about Thanksgiving time in November because, that's typically when, but now's a good time to start because you've got 5 months to put this into place, or just to really, accelerate your giving so that again, you can do it. You financially can, afford it. You have the financial wherewithal to do it. Start doing it so it's not so big at the end of the year when you're like, oh my gosh, I need to contribute $1 billion to make this work. And here we are at December 31st. So
G-
now's a good time to start thinking about it.
got it. Well, let everybody know how they can reach you if they want more information.
You can reach me at my website, rifemartincpa.com, or you can reach me at info@rifemartinaccounting.com. And I'd love to talk with you about this and any other great topic.
Thanks for sharing, Allison.
All right. Have a great day.
You too.
Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.